For this mock exercise, we're going to take a look at the income effects of denominator levels on inventory valuations. And we're going to take a look at the company called Ray-He Company. So let's go into the question. So Ray-He sells razors at $3 per unit. Oops. Okay, so $3 per unit. So that's the sales price. It's denoted by SP. The company uses first in, first out for the actual costing system. So they're using the first in, first out method of inventory management. Fixed over manufacturing cost rate is computed at the end of each year by dividing the actual manufacturing cost by the actual production units. The following data are related for the first 2 years of operation. So first 2 years means this will be the beginning of the year. This is the start of the year, right? So let me write this down. So start of operations. That's 2012. So they had sales of 1,000, but they had production of 1,400. That means that what? That means that the ending inventory is 400. So why don't I write this down here? So you've got ending inventory in this case, or beginning inventory for 2012 is 0 because it's the start of the year. Ending will be the difference between that is 400 units. Now for 2013, we had a beginning inventory of 400 units from last year. We add to it the number of units that we produced, which is 1,000. That's 1,400, less what we actually sold of 1,200. That means our ending inventory is 200 units. Okay? Now, we're given the following data. The variable cost is 700. The variable manufacturing cost is 700. The variable operating cost, so they're saying it's marketing, is 1,000, and the fixed cost is 400. And there you've got the 2 years comparative. Now, it says, prepare the income statement based on variable costing. So we need to know what variable costing method is for 2 years. And then number 2 says, prepare the income statement based on absorption costing. So those are 2 different methods of presenting the income statement, variable versus absorption. Now it says, prepare a numerical reconciliation. So in other words, we need to compare the 2, and there's going to be a difference in their income for the 2 different methods. And we need to provide an explanation of the difference between the operating income under absorption and variable. So we need to do a numerical reconciliation. I'm going to show you a formula how to do that. Now, let's come back to number 4 once we take a look at 1, 2, and 3. Now, before we get started, let's take a look at the difference between variable and absorption costing. So variable and absorption costing differs based on the following. So you see in the middle, these are the various costs that the company incurs. So you've got direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, and in this question, it was just marketing, but here it should include all selling and admin expenses, and both variable and fixed. Now, under absorption costing, you'll see that this is our traditional income statement according to GAAP. Whether it's IFRS or ASPE, this is what we call the traditional, and this is what's allowed for financial statement reporting. And what this is saying is that direct material, direct labor, variable manufacturing, and fixed manufacturing, all of these costs are associated with getting the product from its raw materials to its finished goods state. So this is the cost of manufacturing, and we call this product cost. And by the way, this box, there's the word here, it's called product cost. And these costs, selling and admin, are essentially costs associated with what we call period costs. This has nothing to do with manufacturing of the product, and therefore these are considered part and parcel with operating the business, and we call these period costs. So these costs, if we make more than we produce, these costs are going to be capitalized to the balance sheet called ending inventory. Now, if we use variable costing, you'll see that under the variable costing, we're going to expense all fixed cost. Okay? Fixed cost, and we're going to consider those as what we call period cost. So, for example, in our period cost under variable costing, we're going to expense, as part of normal expenses of the income statement, variable selling and admin and fixed selling and admin, similar to the absorption costing, plus we're going to also expense fixed manufacturing overhead. So, in other words, if we end up producing more than what we sold, then some of those per unit costs that we're going to include in ending inventory will only include variable cost. So these are what we call product cost, and these are period cost. So the difference really lies in this area. This is the difference. So this is the only difference between these two methods. Now, this is allowed under the traditional financial statement reporting, but this one is not. So this is only for management reporting. Now, what's the effect by using these two different ways of recording income? Well, it depends, right? So I've got a chart here that says here are the comparative income effects based on the two methods, and we're going to need to know that when we take a look at this question. Rehi. So if we produce more than we sell, in that case we end up with ending inventory, then our inventory will increase. And that means that absorption income is going to be greater than variable income. Why? Because remember, all fixed costs under variable costs will be expensed, irrespective of whether we overproduce or underproduce in the current year. Whereas absorption costing, some of that fixed cost will be capitalized as part of the per unit cost that will be included in ending inventory. So that's why absorption costing is going to generate much higher income than variable costing. If production is less than sales, that means that our ending inventory is going to be less than our beginning inventory. If there were any change, if there was a beginning inventory, that means inventory will decrease. And of course, the opposite effect will happen. Now, if production equals sales, then we know that if everything that we produce is what we sold, then all of those will be expensed. And of course, absorption costing income will be equal to variable statement income. Now, when we look at the variable versus absorption costing, you'll see that our fixed products cost inventory. So that's one of the difference, right? Absorption costing, yes, we capitalize some of that fixed cost, whereas variable costing, we expense all of those fixed costs. Now, if you think about manufacturing facilities, bulk of the manufacturing costs are really fixed. So this will create differences in income depending on which costing methodology you use to calculate your net income. Now, is there a product volume variance? And the answer is no for variable cost, but yes for absorption costing. Because remember, when we measure the amount of fixed costs allocated to the product, we base it on an expected volume of production. And if we reduce more than what we expected, we're going to over-allocate the fixed cost to both inventory and cost of goods sold. And of course, when we over-allocate, you're going to have what we call product volume variance. And with absorption costing, we're going to have that because we unnaturally pre-unitize the fixed cost to capitalize to either ending inventory or not. Whereas for variable cost, we completely expense that, so there's never going to be product volume variance. Our classification between variable and fixed costs routinely made? The answer is yes, we need to. And absorption costing means, it says infrequently, means yeah, but not as often as we do for variable costing. Now, the income effect, you'll see that we saw this earlier, that you could see that depending on whether production or sales is greater or equal will create different income expectation depending on which method we use. Now, in terms of comparing the income, what are the effects on cost, volume, profit for a given level of fixed cost and a given level of contribution margin? So we know with variable cost is completely driven by unit level of sales, whereas absorption costing, we not only have to worry about unit levels of sales, we also have to look at the unit level of production. In other words, we can start to create different income, different higher or lower income depending on management's motive by increasing or decreasing the level of production to determine how much of that fixed cost gets capitalized to ending inventory. And of course, depending on also what denominator levels we choose to allocate the fixed cost, that's going to create different cost, volume, profit levels. Now, part of this question, the Rahe question, requires us to calculate the difference. Remember in part C, it says, please calculate a reconciliation, a numerical reconciliation of the difference between the two operating income. Well, the way we do that is we take a look at the difference between absorption costing operating income subtract variable costing operating income. And that difference should be equal to the fixed manufacturing overhead that was capitalized to ending inventory. And the difference is going to be the difference of how much we've capitalized of fixed overhead in ending inventory minus the beginning inventory. So if management knows that they're close to their budget target of operating income and they're just slightly below, what do? They end up overproducing, so that absorption income is going to be higher. By increasing the ending inventory, you're going to capitalize much of that fixed cost to ending inventory so that it's going to make the profit bigger or higher than variable costing. Now let's take a look at the question. Let's answer the question. Okay, so let's answer the question. So part A asks us to look at the income for both years under variable costing. So part 1. Okay. I like to do comparatives here, so 2012, 2013. Okay, so I always like to make a mental note. My sales is 1,000 units, and this one was 1,200 units. and my production is 1,400 units. And this one is 1,000 units. So I like to put the word beginning inventory and ending inventory so that I know. I don't have to calculate it. And I already did that, right? But beginning inventory is 0, 400 units. And this one is 400 units and 200 units. Okay? So the revenue. So this is kind of like a little short analysis. Okay. Now, revenue. So we know how much is the actual sale price is $3, right? So 3 times 1,000 is 3,000. And 3 times 1,200 is 3,600. Because we're doing variable costing, let's calculate all variable cost. So starting with beginning inventory, we know that's 0. Now, I'm not going to put the beginning yet because I need to calculate the ending, right, for 2013. Now, what about variable cost of goods manufactured? So the variable cost is $700, right? That's given to us. So 700 actually these are total dollars, not per unit. Okay, so that one there is all 700. That's given. And this gives us cost of goods available. Okay. Deduct ending inventory. We know ending inventory is 400 units. Okay. Now, how much are the variable cost per unit? So we know that the variable cost is $700. And we produced 1,400 units, right? So this gives us 50 cents per unit times ending inventory of 400 gives me 200, right? 50 cents, 50%. And this gives me 500 variable cost of goods sold. Okay, so I start with beginning inventory, which is 0. Now, this 200 is going to be here, because that is going to be the amount that we're going to carry forward, right? We're going to add the manufacturing cost of 700. That's given to us. Now, the ending inventory, we have to do a little bit of calculation here. Okay, which we need to figure out what the per unit cost of ending inventory, of variable cost is per unit, times the number of units in ending inventory to give us 200. That's your variable cost of goods sold. Now, you need to add in there the variable selling. And that one is 1,000. And that's given to us as well. And this gives me total cost of 1,500. And the difference between 1,500 and 3,000 is called contribution margin. Now, we're going to subtract all fixed cost. So let me just put this as a VC. Let me just highlight that so this makes it a little bit easier to see. Okay. Now, the fixed cost, all of it is expensed. So we're going to take fixed manufacturing. And that is 700. That's given to us. And fixed operating, which is 400. To give us operating income of 400. Okay? That makes sense? And then let's move on to the next column. Now, that's the beginning. Now, what about the variable manufacturing overhead? That was given to us at 500, right? To give us $700 of cost of goods available for sale. Now, how do we calculate ending inventory? For year 2, so I want to just highlight this piece here. Let me do the calculation first. For year 2, the variable cost is 500. We're going to divide it by the number of units. Production is 1,000 to give us 50 cents per unit, times how many units is sitting in ending inventory. Well, we know there's 200 units, right? To give us 100. So I just want to put a little box beside this because this is part of the calculation to get us there. Okay? And that gives us variable cost of goods of 600, and variable selling is 1,200 to give us total variable cost of 1,800. So 18 less 3,600 gives us 1,800 contribution margin. Now, the fixed manufacturing and fixed operating is the same each year. To give us operating income of 700. Now, Part B says, or Part 2 says, we need to do absorption costing. So I want to make that comparison. Okay, so absorption costing. We got 2012 and 2013. Okay. Again, we've got the same. So this is the same. So this part here will be the same as up here. Now revenue. Is $3 per unit, and we know we sold, so the revenue would be the same, right? Under variable cost and under absorption costing. Now, cost of goods sold starts with beginning inventory. In this case, it's 0. Variable manufacturing overhead, that's 700. Fixed manufacturing overhead is 700. That gives us 1,400 cost of goods available. Now, the ending inventory, we got to do a couple of calculations. So we know that the fixed cost is $700 divided by 1,400 units. So the unit cost is 50 cents per unit. Now what about variable cost? So variable cost, we know, is it's $700 divided by 1,400 units is also 50 cents per unit. So the per unit cost is $1 each. So this is the per unit cost. So $1 per unit times how many units are in ending inventory? 400 units gives me $400. So I just wanted to highlight this. This is how we calculate the per unit. Okay, per unit of ending inventory. So this gives me minus 400. So 1,000 gives me what they call cost of goods sold. Not contribution margin. Contribution margin is sales minus variable cost. So this is cost of goods sold. Now operating cost is going to be variable, operating, and fixed operating. And variable operating, according to the question, is $1,000 and $400 for fixed. So you can see that the net income, operating income, is $600. And that is higher than the $400. And we expect that, right? According to the rules, because the amount of production is greater than the sales, we know that the absorption costing is going to generate higher income. But I'm going to show you, I'm going to prove to you how that's done. Let's do the next column. So the beginning is going to be 400. That came from this number, right? Okay. Now, the variable manufacturing overhead that's given to us is 500 and 700, right? So cost of goods available for sale is 1,600. Now, what about the ending inventory? How do we determine that? Well, the same thing, right? Ending inventory for the following year. Fixed cost, we know the fixed cost is 700 divided by how many units did we actually produce? 1,000. This gives us 70 cents per unit. Variable cost is 500. How many units did we produce? We produced 1,000. It's 50 cents. That kind of makes sense, right? It should be the same each year. That's why it's variable cost. So the total is $1.20 per unit. So $1.20 per unit times how many units were sitting in ending inventory? 200, right? That gives me $2.40. So this is the other calculation. Okay, for that. And I take 1,600 less 240 to give me cost of goods sold of if I add 1,600 and 240, so 1,600, minus 240, I get 1,360. I forgot gross margin here, you guys. The difference between 1,000 and is 200. 2,000, and this is 2240. Now, what about the variable operating? It's 1,200, and this is 400. These are given to us, and that gives me operating income of 640. And the operating income, this is lower than variable costing. Why? We'll take a look at the ending inventory. The ending inventory is lower. Okay? So let's answer part C. Part C says, prepare a numerical analysis of the difference between the two income. So let's take a look. So let me summarize both years for part 3. So under variable costing, our operating income is 400 and 700. Ending inventory is 200 and 100. Okay, so I'm just summarizing the difference between the income 400 and 700, and ending inventory is 200 and 100. Okay? Under absorption costing, operating income is 600 and 640, and ending inventory is 400 and 240. Now, how much is the fixed manufacturing overhead in beginning inventory? Well, we know it's 0, but how much did we add? We added, for variable costing, we had 400 units times 50 cents, if you remember, right? The fixed is 50 cents, so it's $200. Now, this would be the same, right? Beginning would be the same. And the ending, we know the ending fixed is 70 cents, and there were 200 units left, so 70 times 200 is $140. So, absorption, operating income minus variable operating income, okay, equals fixed manufacturing overhead in ending inventory minus fixed manufacturing overhead in beginning inventory. So that would be the difference. That would be the reason for the difference. Okay, so make that BI. So let me just underline this. Maybe I'll highlight this in yellow. So let's look at year 1. The difference in absorption costing in year 1 versus year 2, this is 2012 of course, is 600 less 200, which is 400, right? Sorry, 600 less 400 is 200. And the difference in ending inventory is 200 less 0. And for year 2, which is 2013, you'll see that the difference in income is 640 minus 700 gives me minus 60 equals the difference in ending inventory is 140 minus 200. Okay, so I'm just going to write down how we got these numbers. So this is the beginning. So let me do this one. The beginning would be 50 cents times 400 units. And this one would be 70 cents times 200 units. Now, part 4 asked us, critics have claimed, so let me show you. Critics have claimed that a widely used accounting system has led to undesirable buildups in inventory levels. Is variable costing or absorption costing most likely to lead to such buildup, and why? And B says, what can be done to counter-react undesirable ending inventory buildups? So first of all, we know that absorption costing you can see from this example, is more likely to lead to inventory buildup. Now, if I was a manager and I'm just slightly below my profit level expectation to receive a bonus, I know that one of the techniques that management will often do is they will produce more than what's needed so that part of that fixed cost is allocated to ending inventory and expensed into cost of goods sold in the following year. So fixed cost, actually manufacturing fixed cost, is allocated or transferred to ending inventory if production levels is greater than sales. Therefore, increasing net income, and again in comparison to variable costing, where all of those costs are expensed. Now, variable costing will counter-react the undesirable inventory buildup But we know that keeping two sets of books, one for accounting, for financial reporting, and one for management, is probably the cost and effort outweighs the benefit. So we may come up with different measurement without abandoning the absorption costing. So other measurements can be used without eliminating absorption costing. And some of that could be charge carrying value for inventory. In other words, if management wants to hold inventory more than what is normal or more than what this sales expectation, maybe we should charge them a carrying cost for holding that inventory. So, we need to be able to calculate a premium charge for that. So B, we could perhaps use non-financial variables that measure inventory levels in performance evaluation. An example of that would be perhaps we might want to apply an economic order quantity model to the company as part of the performance measurement. Okay, so there's just a couple of those examples. Thank you.